Hi everyone and welcome back to the UK Mortgage Market Insights for the week ending the 20th of March 2026. I'm Craig and this week, honestly, there's a massive amount to talk about. The market has shifted significantly and if you're buying, remortgaging or just watching from the sidelines, you need to understand what's happening and why. So let's get into it. And if you haven't already, please do hit subscribe. New videos every week, keeping you up to speed on everything mortgage related. Right, let's start with the headline. Mortgage rates are going up again and quite sharply. Sub 4% fixed rate mortgages have essentially disappeared from the market completely. Major high street lenders, Barclays, HSBC, Lloyds, NatWest, Santander have all raised their rates, and the best buy pricing for 2 and 5 year fixes is now at its highest level in over a year. And it's not just repricing, lenders are pulling deals entirely. At least 530 residential mortgage products have been withdrawn since the 9th of March, around 7.5% of the entire market. The average shelf life of a mortgage deal is now just 14 days. Back in February, it was 33 days, so the market is moving fast, very fast. Now, why is all of this happening? Well, the answer, as so often, is swap rates. Swap rates were sitting at their lowest point since mid-2022, just a few weeks ago. Then, conflict involving Iran broke out, energy and commodity prices spiked, and markets read that as a serious inflationary threat. The reaction was swift and brutal. As of last night, the 2-year swap rate was sitting at 4.2%. To put that in context, that is higher than it was a year ago. All the progress that we made through 2025 and at the start of this year has gone in the space of a fortnight. Yesterday's Bank of England decision also confirmed what markets had already priced in. Base rate was held at 3.75%. The conflict in the Middle East has caused a significant increase in global energy and other commodity prices, and CPI inflation will be higher in the near term as a result. The expected March cut didn't happen, and future cuts are now less certain than they were even a few weeks ago. Geopolitics is driving this, not domestic fiscal policy. Rate increases are not mirroring the mini budget chaos of 2022. This is a global external shock, not a homegrown one. But the impact on mortgage pricing is very real, regardless of the cause. Now, I want to explain something that I think gets lost in the headlines. People see lenders pulling products and think panic, chaos, something's wrong. And apart from the obvious, there is actually a very rational reason for the speed at which this is happening. When there is a level of uncertainty in the market, lenders don't want to be caught holding on to expensive funds if conditions suddenly shift the other way. So when they do go back to market and secure a tranche of funding, they keep it deliberately small. They'd rather run out of a product quickly than be sitting on a large book of money that they've overpaid for. That's why deals disappear so fast right now. It's not dysfunction, it's risk management. Lenders are protecting themselves. The tranches are smaller and the windows are shorter. And the moment that funding is deployed, the product goes. Lenders may well continue pulling more products until the future path of interest rates becomes clearer, though choice typically bounces back after short-term unrest. The practical message here, if you see a good deal, don't sit on it, take your broker's advice because it might not be there tomorrow. Now, UK GDP expanded by just 0.1% in Q4 of 2025, slightly below what the bank had forecast, and monthly GDP was flat in January of this year. Activity remains subdued. Labour demand is weak, and the economy isn't firing. And now we have an inflationary shock coming from outside the country that the Bank of England can't control. All they can do is respond to it. The market implied path for bank rate has increased significantly since the February report, meaning overall financial conditions have tightened. The cuts we were all expecting this year are, at best, delayed. Now, I want to leave you with something that might genuinely surprise you, because I actually think there is a real opportunity buried inside all of this, and it's specifically aimed at first-time buyers. So let me be direct. This is a first-time buyer's market right now, and here's why. When mortgage rates go up, affordability tightens. Buyers can borrow less. The pool of people who can compete for any given property shrinks, and sellers feel that. Offers slow down and chains fall through, and that creates negotiating room on purchase prices that simply doesn't exist in a hot market. Think about what that actually means in practice. If you can negotiate 10, 15, maybe £20,000 off the asking price in a quiet market, that's equity that you own from day one. That's a permanent saving. It's baked into the fabric of your purchase forever. Your mortgage rate, that changes every 2 or 5 years. You get to remortgage. You get to benefit when rates eventually come back down. And we hope that they will. But the price you paid for that property, that's locked in. And in a competitive market, people overpay. Right now, they're not competing with you in the same way that they would be. So yes, your rate might be a little bit higher than you'd actually hoped for, but run the actual numbers. A slightly higher rate on a well-negotiated purchase price can absolutely cost you less over the long term than a brilliant rate on an overpriced property bought at the peak of a bidding war. The people who bought sensibly in quieter markets often come out ahead, so don't be put off by the headlines. Don't wait for the perfect rate while the opportunity passes you by. Get proper advice, understand what you can borrow, and go and negotiate like it's a buyer's market, because right now it genuinely is. So let's bring this all together because it has been quite a week. Swap rates have gone through the roof. 2-year swap rate is now at 4.2%, higher than it was a year ago. All the ground that we gained through 2025 has been wiped out in a matter of weeks, driven entirely by geopolitical tension and the inflationary threat from rising energy prices. Lenders have responded hard and fast. Sub 4% deals are gone, products are being pulled and repriced at a pace that we haven't seen since 2022. The shelf life of a mortgage is now just 14 days, down from 33 in February, and if you see a good deal, you need to move on it. The Bank of England held base rate at 3.75 yesterday, no surprise there. But the message from the MPC is clear. The cutting cycle has stalled and the path forward is uncertain. The economy remains sluggish, GDP is barely moving, labour demand is weak, and inflation is being pushed higher again by factors completely outside the government's control. But, and this is the bit I really want you to take away from this week, for first-time buyers, this market has a silver lining and that should not be ignored. Less competition means more negotiating power. A lower purchase price is permanent and a higher mortgage rate is temporary. The maths can absolutely work in your favour right now if you approach it with the right advice and the right mindset. This is a first-time buyers market, make no mistakes about it. Don't waste it. As always, if you've got questions, drop them in the comments below. I read all of them. Thank you so much for watching. Please subscribe if you haven't already, and I'll see you next week. Take care.